Hello traders, this is John Kicklighter, Chief Strategist for dailyfx.com, here with the Forex Strategy video, and we're going to talk about an indicator that I use very often and I find quite useful for a number of reasons. The average true range, or as you'll often hear it referred to as the ATR, is a measure of activity for the markets. This is very important when we are looking at FX, which doesn't have a centralized exchange and therefore does not have very good volume indicators, and also as a measure of volatility. All right, and a lot of people reference the volatility figures that we like to use in Daily FX. We have access to a number of things. We also have a couple proprietary measured volatility indicators, including the FX Volatility Index, but we can actually use this ATR as a tool that replicates volatility. It's a very good measure of this, in fact, and that in turn can be used into your trading to significantly improve accuracy in terms of establishing when we're having breakout range, trend, momentum development, and a number of other aspects of your trading. So let's take a look at this versatile indicator, and I'll show you exactly how I use it, and we'll look at a particular number of pairs and markets which have some interesting ATR readings right now. The first thing to assess, there are three general states that the ATR can really be used for and improve our trading. One, it measures just simply activity levels. All right, it's important to assess and realize it does have this measurement ability. Two, it actually has sometimes a gauge of directionality to it. Just like implied volatility. Remember, when we look at the implied volatility measure or the VIX indicator versus the S&P 500, those two have a fantastic negative correlation, meaning when the volatility index picks up, the S&P 500 most oftentimes drops. All right, so that's a useful aspect to this indicator as well. And then we also have downshifts and upshifts in volatility. This is important. This is more of the level of changes volatility, which is essentially like saying going from range to breakout, from seeing a trend that is just starting to really gain traction and build momentum over time, or lose that momentum and give you the first signs of an initial reversal. All right, there are many aspects to how we can use this, and far more than what I'm just going to talk about here today, but I'll show you why I find it particularly useful. Now, I think it's important to see the actual indicator itself at work on a particular pair. This is the dollar-yen versus the 20-day average true range. Now, the average true range is calculated in a very simple way. All it is the daily range of every one of the bars that we've had for how many ever days we're going back. This, we're actually going back on 20 days. So we'll take the range of these past 20 days and we'll average it out. So, for example, we can see this session here from Monday was very, very narrow. High and low. All right, you can see it was essentially 30 pips. Wow, it was a really narrow day, really inactive, very quiet. We put that into context with all the other 19 past previous trading days, and you get a measure of activity that looks like this. All right, very, very quiet. And you can see how it's developed over time, and you can change the time frames. This is 20 days, but what if I changed it to a 1-day time frame? All right, I can just alter this. We'll make it 2. Well, let me go down to 1. So 2 trading days. All right. When we take into consideration the Thursday, Friday of last week, huge jump in activity, but then you have today's, which is extraordinarily quiet, just like the prior breakout effort that you had into Thursday, Friday. So it is a good indicator for many different reasons, as you can see just on this one example. But let's take a look through its individual rules. First, I'd like to take a look at just using it as an activity gauge. We looked at it a little bit on the dollar-yen, just only going back maybe 4 or 5 months, but this is an activity gauge for pound-yen, going back over the past 7 years or so. This gives us a very good assessment of this development over time. You can see huge spikes when we did have a very high level of volatility, which coincided nicely with this really big drop. Same with this mid-2010 when things were really starting to deteriorate in Europe. All right, and nowadays we can see that there is more of a positive correlation, which is unusual. All right, we'll talk about correlation in just a second, but you can see once again there's a deviation, a very interesting deviation. All right, and this is a 20-day ATR. Recently, the correlation has been positive, or at least it has been since about the mid 2009. But this is perhaps one of the biggest deviations we've seen since this huge spike to the positive side, though we don't usually see moves to the downside that deviate very long. This is perhaps an indication that conditions are going to change. We change our time frame. This is the average true range of the past 5 days, or one trading week. And as you can see, we are stepping down very quickly, right, for the pound yen. And that's a dangerous position to be in when we look at this kind of congestion. In fact, I have the daily chart of the pound yen up, and you can see that we've worked our way into this congestion pattern, where it's essentially from 159.25 down to the floor down here at 156.75. A very narrow window for this typically very active pair, which even on the 5-day rolling average has a daily range of about 100 pips. So we can cover this entire range within a couple of days, and subsequently this tells us a breakout pressure is coming, a good activity gauge, right? And we can use it as such. This is a ATR in progress of a directional measure. I like to use the S&P 500 as a very good benchmark for this aspect, because it is perhaps one of the more well-known uses of this particular indicator. And that's where the ATR and VIX index are used well in conjunction, because the ATR actually gives very similar readings to the volatility indexes that we typically like to load for you. Now, this is the ATR as it is right side up, so to speak. If I were to flip this indicator upside down, you can see how the big drops coincide, or the big rises in ATR coincide to the big drops in the S&P 500. Why would that be? Well, this is an indication that the declines that we have in the S&P 500 are far more dramatic than the increases. This is how the relationship is between activity, market level activity, and measures or markets that are risk sensitive. So the S&P 500, when you have risk appetite rising, activity levels decline and S&P 500 rises. Right? But when you have a risk aversion sentiment where fear is predominant, there is typically a bigger move to unwind those risky positions, and subsequently there is a big pickup in activity and a drop in the index. Now, this is not just unique to the S&P 500. This just so happens to be also a positive correlation to the same currency pair we were just looking at, the pound yen. Right? And this is actually going to be an indicator that is very similar across all the dollar or all the yen-based crosses, because it's a carry trade pair. Right? Carry trade has a very negative correlation to volatility, because volatility is bad for a carry trade. It means that the carry that we would expect to pick up, daily income, very quiet, very calm, very passive, is going to potentially be offset by changes, sharp aggressive changes in the exchange rate, which is a risk. All right? So when I go back to this longer term comparison between the pound yen and its 20-day moving average, or 20-day ATR, typically we wouldn't expect these positive correlations, because it just so happens to be so quiet that we do have that positive. But as you can see, normally speaking, you have a lineup of where activity actually increases when the market's dropping. Now look at this indicator once again, and we'll look at it in normal position. Look how low it is, and remember how we are positioned when we are talking about the pound yen. All right? That pound yen cross has worked itself into an exceptional rise, and subsequently is now in a congestion pattern, potentially looking at a breakout. Right? So those directional indicators can be very useful as long as you are looking at the pairs that have the correct relationship on that particular aspect of the market. All right? Now, the change in activity can be very useful. When we look at, let's say, a pound yen, which is incredibly quiet now, but that can actually be a measure of extreme. this might be too extremely quiet given the conditions that we have in the underlying, and also with event risk. When we look at the economic docket for the UK, we know that event risk is going to pick up, starting with Tuesday's CPI figures, and then really kick in on Wednesday's jobless claims and BOE quarterly inflation report. So you put that entire picture together, and you have a complete picture. All right? Market conditions have essentially been assessed by this ATR indicator. So we have very different readings on this. We can call this an extreme low, but we can also see degrees of activity both increasing and decreasing. For the dollar yen, which is another yen-based cross, you can see that we are working our way down to our lowest level since the beginning of the year. All right, these are the most quiet conditions that we've had since the beginning of the year, and that creates some tension as well. We have a nice wedge pattern, just like the pound and yen, and I have these boxes here because they relate to the Bank of Japan stimulus program. This big lead up in the yen started a number of months before the actual stimulus program was introduced. And guess what? It started around September, October. We are at November, and we are expecting another stimulus program probably at April or around April, when the Japanese government decides that they're going to, or the Japanese government puts the pressure on the Bank of Japan to actually induct a second round of stimulus. All right? So we have a similar situation in many circumstances, including the really low activity report, where it doesn't stay this low for very long. All right? So that's a good indicator. We looked at the pound yen, but what if we look at a couple other pairs outside of the yen crosses? Pound kiwi, off of many people's radars, but look at this technical setup. You have a descending trend channel where you have a nice rising floor of lows. It's easier seen on the 8-hour chart. Right, you can see that descending channel and the technical pressure that we are currently facing. A possible reversal or a possible break to the outside, regardless of direction, it's actually a break consideration. There is breakout potential, bullish or bearish. All right. So when we go back up to the daily chart, looking at the average true range figure, you can see that these markets are excessively quiet. They're the most quiet we've seen since way back here. All right. And look at the conditions that we had back then. You had two opportunities of first this reversal and then subsequently this break to this aggressive move. It's not a guarantee that you're going to have the same thing this time around, but it certainly does add another piece of information to that assessment. Another pair, Aussie Kiwi, off the beaten path. All right, we can do this for all the standard pairs, but I encourage you to do this yourself. This is another pair off the beaten path, Aussie Kiwi. You can see the 8-hour chart here, the congestion that we have here. Very, very tight, remarkably tight. When we look at it on a daily chart, we end up with a number of dojis. All right? Very unusual to see this technically speaking. And you can see that when we assign it a longer term pattern, and you look at the average true range, conditions have been quieting as this wedge has set up, and that is more likely to coincide with an extreme low and subsequently lead us to a breakout. Now I'm looking at shifts that go from inactive to potentially active, but we can go back the other way as well. When you see big trends that are going to eventually become, let's say, a range. All right, S&P 500 has been one of the big arguments for this one. We had really big active markets, but they steadily declined in terms of activity between their subsequent pullbacks. All right, so the pullback we had here in 2011, and as it started to revive its run to the upside, you had a rapid cooling in price action, which eventually set up the next correction. All right, right now you've had very, very quiet conditions in general. We move it up to the 20-day. This is actually a 10-day. You can use any time frame you want, but you can see that once again, conditions are quieting. All right, which is not very conducive to this consistent run to the upside. If this is not going to be a very impressive move, if it doesn't have a lot of momentum to it, it can actually turn into a stalled bull trend and subsequently instigate the next turn. The question is whether the next turn is going to be a shallow move or a much deeper move. All right, that's where we have to add in the additional technical fundamental considerations, but this ATR gets us very close. Hopefully that helps you out. And there are many other indicators that you can use and incorporate into your trading, but the ATR is one of the ones that I like to use very often when I do my technical analysis. So hopefully you can start using it within your own trading and use it to a high degree. Thank you for joining me today, guys. We'll do another Forex Strategy video tomorrow.